The complete guide to understanding ETFs. An ETF is a type of investment fund that trades on stock exchanges, much like individual stocks. Exchange-traded funds, ETFs, have emerged as an important financial instrument in the modern investment landscape. These funds combine elements of mutual funds and stocks, offering investors a flexible way to access a range of markets. Understanding the mechanics, benefits, and potential risks of ETFs is essential for anyone looking to incorporate them into a broader investment strategy. What are ETFs? ETFs represent a type of investment fund traded on stock exchanges. These funds pool resources from multiple investors to build a diversified portfolio that can include stocks, bonds, commodities, or other securities. Unlike mutual funds, which are priced only at the end of the trading day, ETFs are bought and sold throughout the day at market prices. How ETFs function. ETFs are managed by professional fund managers who aim to replicate the performance of a specific market index, sector, or asset class. Investors purchase shares in the ETF, which provide proportional ownership of the underlying assets. This structure allows for broad exposure to various securities without the need for individual asset selection. Different types of ETFs. ETFs are designed to cater to diverse financial objectives. They range from equity ETFs, which focus on specific stock indices or sectors, to bond ETFs targeting fixed-income securities. Commodity ETFs provide exposure to raw materials such as gold or oil, while international ETFs focus on foreign markets. There are also thematic ETFs aligned with trends like renewable energy and more complex options such as leveraged or inverse ETFs tailored to advanced trading strategies. Advantages associated with ETFs. ETFs are widely regarded for their flexibility and cost-effectiveness. They offer access to diversified portfolios through a single transaction, reducing exposure to risks associated with individual securities. Their ability to trade throughout the day enhances liquidity, while their typically low expense ratios make them a cost-efficient option. Additionally, the transparency of ETF holdings and their tax-efficient structure are often cited as key benefits. Drawbacks to consider. Despite their popularity, ETFs are not without limitations. Trading fees can accumulate for those who buy and sell frequently, potentially reducing overall returns. Some ETFs may provide overly broad exposure, which can dilute gains from high-performing assets. Additionally, they remain subject to market volatility, and complex products like leveraged ETFs may carry heightened risk, making them unsuitable for long-term strategies. Factors to evaluate when selecting an ETF. Choosing an ETF requires careful analysis to ensure alignment with specific investment objectives. Key considerations include assessing the ETF's stated objective and the benchmark it tracks. Expense ratios are also critical, as lower fees can have a compounding effect on long-term performance. Investors may also wish to evaluate the ETF's liquidity, tracking error, and potential tax implications. Comparing ETFs and mutual funds. Although ETFs and mutual funds share common features, they differ in significant ways. ETFs trade on exchanges like individual stocks, offering real-time pricing, whereas mutual funds are priced at the end-of-day net asset value (NAV). ETFs are predominantly passively managed, while mutual funds often involve active management, resulting in differing cost structures and tax treatments. Are ETFs a suitable option? ETFs provide investment strategies with an accessible and efficient means to achieve diversified market exposure. They cater to a wide range of financial goals, whether focused on long-term growth, income generation, or exploring global markets. However, investors should conduct thorough research to understand the characteristics and potential risks associated with specific ETFs before including them in a portfolio. Legal disclaimer. The opinions expressed in this article are those of the author and do not necessarily reflect the views or positions of KISS PR or its affiliates. This content is provided for informational purposes only and should not be construed as legal, financial, or professional advice. KISS PR assumes no responsibility for any inaccuracies, omissions, or delays in the information provided and disclaims liability for any outcomes resulting from its application. All information is presented on an as-is basis.